Hey everybody, John King with Summit Funding. Here I am on Friday the 13th, coming to you live with my Financial Friday. So thank you for joining me for Financial Fridays today. As a reminder, every single Friday, I'm going to come to you with great information about a number of different topics. Today's topic is going to be about reverse mortgages. We've recently had topics ranging from insurance, everything you need to know about insurance. We've talked about things like wealth building and managing your debt and how to get out of debt, and 6 steps to financial freedom. We've talked about down payment assistance programs. We have lots and lots of different things that I'm going to be covering with you every single week. And I'm super excited to be joining you or having you join me today to talk about a topic that is super near and dear to my heart. And that topic is reverse mortgages. So thanks for joining me. Hope you're going to get a lot of really, really good information about this. Remember to sign up at financialfridayslive.com or go to my YouTube channel and you can subscribe there and get information about future topics and to see prior topics that I've covered in the past. So I'm going to start by sharing a personal story. Before I do that, I've got about 7 or 8 of you that are currently watching live. Whether you're watching live right now, whether you're watching this recorded after the fact, I'd love for you to put into comments what questions you have about reverse mortgages. Maybe you know a lot about them, but you have some concerns. Maybe you know nothing about them and you've heard some things. There's some bad things that people have heard about reverse mortgages. And I want to hear what you want to make sure we get out of this hour together today. So I got a lot of information I'm going to cover, but I want to make sure that I cover what you want me to cover. So please make sure to put that into comments. If you're watching after the fact, then I'll be able to respond to them later and make sure that I cover any questions that you have that I didn't cover in this topic. So the first thing I'm going to do is start with a personal story near and dear to my heart. 2007. November of 2007, my wife and I were my wife was pregnant. I wasn't. My wife was pregnant with our oldest daughter. And we were about to give birth. We ended up having my oldest on November 16th of 2007. About 2 weeks before my daughter was born, we found out my father had terminal cancer. And my parents lived in the Bay Area at the time. They lived in the house that I grew up in. And it was pretty serious. I mean, very serious. He had liver cancer, and he survived a few months. So he made it through February of 2008. And it put my mom in a position where she had a house that was way bigger than she could afford. And she lived in the Bay Area. Her 3 kids didn't live in the Bay Area anymore. As a matter of fact, well, one did. I at the time lived in Elk Grove, and my other brother lived in Brentwood. And it was just super, super expensive for her. The cost of that home, the fact that she would have had to continue working in order to afford to make the payment on that home, and it was significantly larger than what she needed, given the fact that she was the only person left in that house. So we made the tough decision to sell the family home, and we ended up having her move out to Manteca, and she bought a home at Del Webb. And she, from the sale of the home and paying off some other debts and stuff like that, she had about $150,000 at the time to put towards the purchase of the home. And then she wanted to set aside some other money for savings and future needs. But that meant that she was going to owe about $150,000 on the home that she was buying. And she was going to have a monthly payment on there. And given where her Social Security income was, it put her in a position where we talked about the numbers and said, gosh, this really is going to make it really tight for her, and she's going to have to continue working. And after talking to my 2 brothers and talking to my mom about the options, we decided the right option was for her to get a reverse mortgage. And she took out she bought the home in mid 2008. At the time, you could not use a reverse mortgage to purchase a home. So we did a traditional mortgage. She put 50% down, and then she did a reverse mortgage in order to pay off that traditional mortgage. It's now 2022. So what are we, 14 years later? My mom's still in that house. She's never made a mortgage payment in the last 14 years. She hasn't had to work in the last 14 years. She's been able to enjoy her life. She's been able to travel some. She's been able to volunteer. She's been able to live off of Social Security. And that's really why reverse mortgages are so important to me. I'm not saying they're the right thing for everybody, but it certainly was the right thing for my mom, and it certainly was the right thing for my family. And I want to help you figure out if this is the right thing for you or for your mom or for your family. and decide the pros and the cons of whether or not this is something that you should do. So hopefully you'll join me in my journey over the next 55 minutes and explain why this is a good idea. I'm going to explain why it's a bad idea. I'm going to give you the pros and the cons, the ins and the outs, the ups and the downs to help you understand if this is something that is appropriate for you and for your family. So let's go ahead and get started with what is a reverse mortgage and is it a good idea? Remember, if you're watching me right now, whether you're watching live or recorded, please post in comments right now what it is that you have questions about. Do you know somebody who's had a reverse mortgage? Do you have one yourself? Have you had experiences with them before in the past? Are they positive or negative? I'm okay with anything. I just want to know what you're thinking and to make sure to address those things that you have brought up. All right. So the topic, big picture, what is a reverse mortgage and is it a good idea? Let's get started specifically. Okay, John, what is a reverse mortgage? It's super simple. A reverse mortgage is simply a mortgage where instead of you making a payment to pay down the balance, you make 0 payments and your balance goes up every single month to cover the interest that is due. Now that sounds kind of scary. It sounds like, wait a second, John, this sounds like a horrible idea from the beginning because I'm not paying down my mortgage balance. Well, what you're doing is you're moving money from one pocket to another. The idea is that this works if you have a significant amount of equity in your home. And I'm going to talk later about the numbers and the statistics of how much equity in general you need to have. But for a lot of people, it is super important to age in place, to not have to move to a smaller location, to not have to worry about making your monthly payments. And you've got a bunch of equity in your home that currently is just going to sit there and it's going to go to your children, which is great. It's important for a lot of people to leave a financial legacy to their children. And that's one of the negatives of doing a reverse mortgage is you potentially lose some of that financial legacy. But the fact is, every dollar that you were going to spend on a traditional mortgage payment stays in your pocket, which means that if your lifestyle never changed, then instead of writing a check $1,000 a month to pay the principal and the interest on your mortgage, instead, your balance on your mortgage goes up. Now, remember, it won't go up by the full $1,000 because only a portion of that $1,000 that you would pay on a traditional mortgage is interest. And it's only the interest that's added. But the truth is, on a traditional mortgage, the principal you paid would have lowered the balance and you're no longer getting that benefit. So you really are taking the $1,000 a month you were going to pay for principal and interest, and it is now going onto your mortgage. So you're going to owe more money, but you have $1,000 left in the bank. So if you didn't spend anything different, you would end up with more money in savings equal to the amount of money that you added to your principal balance. Now, interest it skews that a little bit. How much interest do you make on your savings versus how much interest did you pay on the reverse mortgage? But the fact is, you're not losing money that you could have given to your heirs. You're exchanging where that money is located. Instead of it being a huge amount of equity in the property, you're now growing your balance in your savings account. But John, one of the biggest reasons why I want to get a reverse mortgage is because I don't want to have to write a check and I'm having a hard time paying for everything else. I need to take the money I'm spending on my house payment and use it to buy medication, to buy gas, to travel a little bit. I want to do some things with my life. And I've heard a lot of my friends say they can actually spend more of their retirement enjoying life instead of spending their retirement trying to figure out how to simply survive. And that's true. But the fact is, you're not going to have extra money in savings if you spend it. But you never would have had those experiences. You might not have been able to pay for the prescriptions in the first place if you didn't have the reverse mortgage. So it's critical to understand everything is a trade-off. And yes, your balance is going up on a reverse mortgage, but you're saving money that you now can put in checking that you're either spending on something that you otherwise would not have been able to spend on, or you're actually saving the money into your checking and savings accounts, which will allow you to give that money to your heirs. That's a big picture idea of what a reverse mortgage is. And I'm going to dive into a lot more details as we go through, what is this? We've got another 50 minutes left. So let's go ahead and talk about why now is a good time to consider a reverse mortgage. Okay, first and foremost, uh, I'm going to start at the bottom of this one. We have a significant amount of equity that has built up, especially over the last 2 years. And your reverse mortgage amount that you get to borrow is based upon the current value of the home. I remember talking to a client back in 2005. I was working for Wells Fargo at the time, and this client came in and talked to me about doing a reverse mortgage. And she said, John, I'm thinking about doing a reverse mortgage. My husband and I want to have the insurance policy against needing money later down the road. But I don't like the idea of all the fees that it costs to do a reverse mortgage. I think I'll wait to get it until we need the money. Well, that's great. And it was a good concept, saying, I don't know if I'm going to need the money. And so they didn't get the reverse mortgage because they didn't want to spend the pretty significant amount of upfront fees to establish the reverse mortgage if they never ended up needing it. The problem is they ended up needing it in 2009. In 2009, housing prices had dropped significantly. And at that point in time, they could not access the amount of money they needed to pay off their mortgage. And it put them in a position where a reverse mortgage was no longer an option. Now, I don't expect housing prices to drop anywhere near as much as they did back in 2007 to 2009. If we look historically, housing prices always do a little bit of ups and downs, and they've certainly gone up a lot over the last 2 years. So at some point, are we due for a little bit of down? Absolutely. But in history, we haven't seen as big of a down as we did in 2007 to 2011. And that was caused by bad mortgages and a crisis in real estate and mortgage industry. We were giving loans to people that didn't qualify. Today, everybody who has a mortgage was qualified for that mortgage. Their income had to be verified. Their credit had to be verified. And so we're not going to be in a position where a bunch of people have adjustable rate mortgages and the market's going to crash. But the truth is, we don't know that how soon values are going to go down some or go up some more. But we do know is in the last 2 years, values have gone up 36% in the last 2 years. I have a client who bought a home last year. It was about a $450,000 home in the city of Stockton. And today it's worth about $560,000. In 1 year, they gained $100,000 in equity on that home. That's why I think the biggest reason why now is a good time to think about it is because we've got a significant uptick in values. You can lock in your reverse mortgage amount at that time. So that's reason number one. I talked already about the fact that you can never make a mortgage payment again, ever. So you have the ability by taking out a reverse mortgage to never have to pay your principal and interest ever again. And that will help you with budgeting as you move into retirement and figure out, how do I want to spend my retirement years and where do I want to spend my money? The next thing is you're going to have access potentially to more money down the road. I'm going to talk in a few minutes about how reverse mortgages work and how you access the money. And in some cases, you're going to have the ability to tap into money down the road, and you're not going to have to pay fees to tap into those because you already have the line of credit established. Here's a super important one. It doesn't impact your taxes. You're borrowing the money. It's going to get paid back when you sell the home or when you pass away and your family refinances it. And I'll explain all of that in a few minutes on how that works. But the fact is, it's not income. So when you look at your taxes and you're like, oh my gosh, John, I'm so worried about my required minimum distribution on my 401k. I'm worried about my Social Security. I've got a part-time job, but I can't make more than a certain dollar amount, or it cuts back on my Social Security, which is the last bullet point I've got here. Reverse mortgages have zero impact on any of those things because a reverse mortgage is not income. So you're not having to worry about it when it comes to your Social Security amount. You're not going to have to worry about it as far as income taxes. So super, super important to understand that when you're thinking about reverse mortgages. Those are some reasons why now is a really good time to consider a reverse mortgage. All right, so now let's talk about who qualifies for a reverse mortgage. The first and foremost is that at least one person on the home has to be over 62 years old. Now, there's some major challenges with reverse mortgages in the past, and this is one of those major challenges that has changed. And so I want to stop and address it because you may have heard in the past that there's issues with what if one spouse is over 62 and one is not, and the rules have changed over the last few years that may have given you a reason to think this is a horrible idea because I heard bad things about that. Well, let me explain how this used to work versus how it works now. It used to be that only the people over 62 could remain on the loan and on title to the home. That is no longer the case. You have to be married to the other party, but as long as you've got a spouse, one of you being over 62, the other one can be under 62, and you can both still be on the loan. Critical to understand that, because it comes down to what happens when the last borrower can no longer live in the home or passes away. The old rules, you would have had people who would kick their spouse purposefully, the spouse would agree, kick their spouse off of the ownership of the home in order to get a reverse mortgage. And the problem is, when the older spouse who took out the reverse mortgage passed away, the younger spouse had to refinance it into a regular mortgage, and they can't afford it, and they often lost the home. That is no longer the case. If you are married and you own the home with your spouse, as long as one of you is over 62, you can take out a reverse mortgage, and the person who's under 62 still gets to keep the house, still does not have to make a mortgage payment, even after the older person passes away or cannot live in the home for a year. That's critically important to understand, because it's not a myth, it's a fact that has changed. And so you qualify for a reverse mortgage as long as at least one spouse is over 62 years old. The truth is, that's it for qualification. Aside from that, there are issues when it comes to your income and your credit and your loan to value. And so let's talk about what could cause you to not qualify for a reverse mortgage. So these are the things that would qualify you to not, this would cause you to not qualify for a reverse mortgage. First of all, what I just said, you have to be, somebody on title has to be over 62 years old. And remember, if there's somebody under 62, you have to be married to the person that is over 62 years old. The second reason and the biggest reason is you don't have enough equity in the home. That's the number one struggle for people who talk to me about reverse mortgages. Is they say, John, I want a reverse mortgage, but when we run the numbers, we can't loan you enough money to pay off the mortgage that you have on the home and the fees that go along with doing a reverse mortgage. And so when you think about that, it is really a calculation. And I'll talk in a few minutes about how we calculate the loan amount and what pieces come into that. But it is the number one reason why people who talk to me about reverse mortgages don't qualify, is because the house value is not high enough in order for us to loan them enough to pay off their current forward mortgage. And that is the biggest reason why you won't qualify. The final other reason you won't qualify really isn't about not qualifying. It's about credit and income issues. So maybe you don't have very much income and you have a whole bunch of debts. Maybe your credit is not so good, or you've had challenges paying your property taxes and homeowners insurance in the past. And so we are not going to stop you from getting a reverse mortgage, but we are going to do something called a LESA. Okay, so let me explain to you what a LESA is. A LESA is a lender enforced set aside. Lender enforced set aside. So I want you to think about trust. Do I, as the lender, trust that you have the willingness and the capability to pay your own property taxes and homeowners insurance? First of all, why does that matter? It matters because if you don't have homeowners insurance because you didn't make the payment and the house burns down, then the security we have through the reverse mortgage is lost. There's no more, the insurance company is not going to pay to rebuild it. And we're stuck having a loan on a piece of land with a pile of burnt sticks on it. And you don't want that, and we don't want that. So we've got to make sure, it's critical to make sure that your insurance is paid. And if you have a history of not paying debts on time, or your income says we're worried you won't be able to afford to pay it, then we're going to require the LESA. I'll explain in a minute how the LESA works. The same holds true for property taxes. If you don't pay your property taxes, the county can foreclose on your home, and we as the lender get nothing. You as the owner get nothing. A property tax debt is what's called the highest priority lien on your home. The county can foreclose on your home and the bank gets nothing and you get nothing. That's why it's critical on any type of mortgage that the mortgage company confirms that your taxes and insurance can get paid. And most of the time they include that in your mortgage payment. Well, the problem is you're no longer going to make a mortgage payment. So your taxes and insurance are going to have to still get paid. We'll talk more about that in a few minutes. But the LESA is a required amount of money that is set aside that says, hey, if we had to pay your insurance and your taxes every single year until basically for your entire life expectancy, how much money is that going to take? And whatever that dollar amount is, that's the amount we are setting aside out of your available funds. Okay. Then every single year, we just pull from there and we pay your property taxes. We pull from there and we pay your homeowner's insurance. So we will pay for those out of the money that we have set aside of your available funds. I had a client recently who asked me, John, I don't want my taxes to be included in the amount that is added to my reverse mortgage. So if you guys don't trust me to make my own mortgage payment, my own payment on taxes and insurance, I'm not sure that doing a reverse mortgage is a good idea. And what I explained to this client was just because we require you to set aside money for future payments of taxes and insurance, and we will write the check for it, doesn't prevent you from writing a check to the reverse mortgage to pay back the taxes we paid. Think about that for a second. Let me say this in a little different way. You can make a payment towards your reverse mortgage anytime you want. There are people who are saying, you know what, John, I don't need a reverse mortgage right now. I can afford the payment and I don't want my balance to go up. You can write a check every single month on the reverse mortgage. Now, if you truly can afford your payment and there's no need to have a reverse mortgage, don't get it. But if there's some reasons why it's a good idea to have for future needs, but you don't want to actually have the balance start growing today, you have the right to write a check as often as you want, and that pays down the balance of the reverse mortgage, and it leaves more room then, kind of like your credit card, leaves more room for you to borrow that money again later. So if you want to pay us back for your taxes and insurance, even if you have a LESA, you absolutely can. It is not required that they are included in your balance. We just have to pay it and you can pay it back down. All right, so I want to talk now about the negatives. I want to talk about why a reverse mortgage is a bad idea. Okay, first and foremost, the fees. The fees are super, super expensive. Now, why are they expensive? Well, you're paying all the normal fees that go along with doing a regular mortgage, but you're also paying for mortgage insurance. Mortgage insurance is a one-time fee that is paid to FHA, the Federal Housing Administration, and that is what they use to pay back the lender if there is a loss at the end of the transaction. In other words, let's pretend that you live for the 50 more years and the balance goes up significantly and housing prices go down a little bit at the time that you no longer have the reverse mortgage. Then the bank is upside down. The bank is not losing money. FHA reimburses the bank for that cost. That is the only reason why reverse mortgages work, is because the federal government is backing these through an insurance policy. But you're paying for that insurance policy. So you're looking at anywhere from $10,000 to $15,000 of mortgage insurance, and then another $10,000 to $15,000 of normal loan fees. You typically have an origination fee of around $6,000. You've got title companies fees, appraisal fees, credit report fees. All of that stuff adds up. It becomes super, super expensive, and it is the number one reason why getting a reverse mortgage is a bad idea, especially if you don't plan on needing it for a long period of time. If you think, hey, I'm 65 years old, I'm going to continue working in this area for the next 2 years, and then I'm going to retire at 67, and I'm going to move to Arizona. It's a horrible idea to get a reverse mortgage on your current home because you just added $20,000 to $30,000 of fees that you now have to pay back when you sell the home in 2 years to move to Arizona. Now, nobody knows what the future is going to bring. Nobody knows if we're going to live tomorrow, let alone 2 more years. But it's about if you know your plan is to not keep the home. And if you're planning to not keep the home, typically at least 4 to 5 more years, it's probably not a good idea to do it because of the super expensive fees. Now, there's some options where the mortgage insurance is actually added as a monthly amount instead of as a one-time fee. In general, we can look at that. If you think you're going to get rid of the mortgage sooner, that is an option to consider, but it long-term ends up being way more expensive. And so usually people are doing the option where they're paying all of the cost up front, but you're not writing a check for it. It's just added to the initial balance when you start the reverse mortgage. And I'll show you some numbers in a couple of minutes that will help that make a little bit more sense. The second reason why a reverse mortgage is a bad idea, it is not transferable to another property or another person. So I'm gonna give you two examples. The one I just gave you a minute ago, I took out a reverse mortgage and in 2 years, I'm gonna sell this house and move to Arizona. If you want a reverse mortgage on the house in Arizona, you've got to pay all the fees all over again to take out that reverse mortgage. So it's not transferable from one property to another. It's also not transferable from one person to another. So let's say that you are 90 years old and your daughter is 60 years old and you want to take out a reverse mortgage right now, but you know that in a few years, you want to put your daughter on the reverse mortgage so that when you pass away, your daughter has the ability to keep the house and stay on the reverse mortgage. You cannot add your daughter to your existing reverse mortgage. Now, if she's over 62, you and your daughter together can do the reverse mortgage. But if she's under 62, clearly you're not married to your daughter. I hope you're not. So in doing a reverse mortgage, your daughter can't be on the loan and you cannot transfer your reverse mortgage to her. So when you're gone, your daughter either needs to do a traditional mortgage, or if she's old enough, she needs to do a reverse mortgage, but she's going to pay all the fees all over again. All right. The third major negative to doing a reverse mortgage is you're treating the house like a financial asset. And if there's sentimental value to the home, you risk losing that home and not passing it along to future generations. Now, I want to pause here and be really clear about this. If you think about my story I told at the beginning of this presentation, my father passed away. That was the family home that we lived in forever. I grew up in that home. But the truth is, myself and my two brothers were never going to move back into that house. And it was too big for my mom. So sure, there's some sentimental value to that home, but that home isn't sentimental to the family. Imagine if the home I grew up in was a home that my great-great-grandfather built with his bare hands. And we have 3 generations of the King family buried in the back 40 of the home because we have built an estate there and we plan on passing it down from generation to generation. And then my kids can't wait until they have the opportunity to move into that house and raise their kids there. If that's the case, a reverse mortgage is a horrible idea because although you have the ability to keep the house, and there's a few ways I can explain that you're keeping the house, you might not be able to. Because the balance has gone up so much, the next person might not be able to afford the payments. So if there is sentimental value, if it's important that this house never leaves the family, it's a horrible idea to do a reverse mortgage on that home. By the way, I didn't even put this in my presentation. I want to be super clear. You can only do a reverse mortgage on your primary home. So if you have multiple homes, you cannot do them on your vacation property. You cannot do them on your rental property. It is only allowed on your primary home. Okay, so having said that, let's talk about the next thing, which is the risk of not leaving a financial legacy to your heirs. Let's be honest. Most of the equity, most of the inheritance that people build to give to their children is in their home. And you are giving up the guarantee of that money being transferred to your children. For some people, that is critical. They've literally worked their entire life to have the ability to know their children are going to be better off financially than they were. That is commendable. And I have nothing negative. I'm not putting a negative spin on that. I'm saying that's great. For some people, that is truly the most important thing. And they would rather sacrifice their own well-being, their own financial well-being, to make sure that they're leaving a financial legacy for generations to come. If that's you, a reverse mortgage is a horrible, horrible idea. I had a client I talked to about 5 years ago, and we talked about all of these negatives. By the way, every time that you sit down with me to talk about a reverse mortgage, we're going to go through these negatives every single time because I want to make sure that we're talking about them for you and that you can check them off in your head saying none of those things matter to me. Well, as we talked, everything made sense for the client until I brought this up. And they said, John, we're not going to do it because we have a daughter with disabilities. And we know that right now we're the only caregivers for our daughter. When we pass away, we have to leave money for her to be taken care of. We do not want her to be a ward of the state. And so, as much as it would help us financially to do a reverse mortgage today, it's a horrible plan because we couldn't fathom the idea of our adult disabled daughter being a ward of the state. We need to leave this nest egg for her so that she can be cared for in the long run. That's a good example. That's a pretty serious example of where not leaving a financial legacy is a big deal. Now, the truth is, all of us want to leave money for our kids, but are we going to sacrifice our own financial well-being to do so? I'm not sure that's the right move in most cases. You worked really, really hard. You raised your children. You turned them into amazing adults. And now it's their turn to build their legacy and build their finances. And if you can give them a leg up when you're gone, that's great. A reverse mortgage does not take away their ability to get the equity from your home, but it lets you tap into it and use it to have a better lifestyle. When my mom got her reverse mortgage, my brothers and I talked about it, and we were super clear. We're not waiting for an inheritance from mom and dad. And if mom uses all of the money equity in the home, but is able to have a better retirement, we're happy for her. And we're totally okay that we didn't get anything from our parents as an inheritance. So it is a conversation you want to have with your kids, but I do want to caution you, if it's the right thing for you to do, be careful not to let your children guilt you into not doing it, because you're sacrificing your financial well-being. You're sacrificing your physical health sometimes and not being able to afford to pay for medication or gasoline to get to the doctor in today's crazy inflation world. So you want to make sure that you're making the right decision for you, knowing what the pros and cons are. All right. The last reason why you shouldn't get a reverse mortgage is it's usually not a fixed rate. Now, that actually isn't a bad thing. And I'm going to postpone that. And we're going to talk more about that later. So let's go ahead and keep on going. And I'll talk more about fixed rates versus not fixed rates in a few minutes. Okay, so do I still have to pay my taxes, insurance, and homeowners association? I talked about the LESA before, so this is kind of just a reiteration of this. The answer is 100% yes. Your normal mortgage you have right now probably included your traditional mortgage, your forward mortgage, probably had taxes and insurance included in the payments. But when you take out a reverse mortgage, we are simply taking the principal and the interest and adding it to taking the interest and adding it to the balance, and you're not paying any principal down. Now, if you have a LESA, a lender enforced set aside, we're going to pay the taxes for you. If you have available funds in your line of credit, we'll explain that in a moment. If you have available funds in your line of credit, then you can use the line of credit and every year just ask for money out of the line of credit in order to pay your property taxes. So you can take the money from the reverse mortgage by choice to pay your property taxes, assuming you have enough money available in your line of credit. But you are 100% responsible for the payment of your property taxes, homeowners insurance, and homeowners association, unless you have a LESA, a lender enforced set aside. All right, guys, we are halfway through. I want to pause for a quick second for a commercial. No, it's not a commercial. I do want to ask if you have questions. We've got about a dozen people watching right now on different platforms. So shout out, tell me what you liked about what I talked about so far, what you learned about what I talked about so far, or what questions you have that you want to make sure I answer before we're done. So I'd appreciate some comments and some feedback. I hope I'm not speaking to people who aren't paying attention and just have me turned on. Like my mom probably has this turned on 4 different computers just to make me think that I've got a lot of people watching. I would love to get some comments to prove to me that my mom isn't in 4 different places, just making me feel special. I love my mom. She makes me feel special, but I want some confirmation that there's real people out there. So give me a comment, give me a shout out, give me a like. I would appreciate that. Okay, so let's move on to more of the meat and potatoes. There are 3 ways to use the money from your reverse mortgage, and these 3 play against each other. So what we have to think about is you have to think about a pie. You have a pie of dollars that you can tap into, and you can tap into that pie in any of these 3 ways. But if you use up the pie 100% with a lump sum, there is no more money for monthly payments, and there's no more money for a line of credits. If you use up the entire pie with a monthly payment amount, So the monthly payment says, hey, we expect you to live this long. You want to be paid this much money over the life. This is how much we can give you in monthly payments. And that uses 100% of the pie. There's no money left over for a line of credit because all the money you had available is allocated to the pie of monthly payments. So let me explain to you how each of these works, but I wanted to first give you the big picture that there are three components: the lump sum, the monthly payments, and the line of credit, and they comprise a pie that says you could take, if your pie says you have $300,000 of available funds, you could take 100,000 of that and take it as an upfront lump sum. You could take 100,000 of that and turn it into monthly payments that pays you a little bit of money over time, kind of like an annuity, if you think of it that way. And then you can take the other $100,000 and leave it as a line of credit. But you can't take $300,000 as a lump sum if your cap is 300,000 and still expect to have money left for a line of credit or monthly payments. So let's talk specifically about each of those. How does the lump sum work? So first and foremost, a lump sum is the upfront cost of your loan is your first lump sum payments. So that $15,000, $20,000, $25,000, $30,000 in cost, depending upon the size of your reverse mortgage, is the first draw on your reverse mortgage. Okay, so you are paying that amount out. And Penny has a great question. Penny, I'll get to that question a little bit later. Thank you. So you are paying out as your first balance on the reverse mortgage, the fees for doing the loan. The second lump sum draw that has to happen is to pay off all debts that are on your home. If you have a mortgage currently, that has to get paid off. If you have a second mortgage, that has to get paid off. If you have any other liens or judgments, those have to get paid off. So the first critical component when we think about can you qualify for a reverse mortgage is, does your maximum allowed borrowing amount cover the required lump sum dollars? That is your fees, your current mortgages, and any liens or judgments. It's the number one reason why people don't qualify for a reverse mortgage, because they have too many obligations to pay off and not enough money in equity, not enough money in the available funds to borrow. And I'll explain that calculation to you in a couple of minutes. Okay. So you also now can choose to say, hey, I want to take more money out as my lump sum, but there's a cap. There's a limit. I'll talk about this in a few minutes, but you cannot get 100% of your available funds as part of your lump sum in the beginning. I'll explain that in a couple minutes. How do monthly payments work? Okay, so I want you to think of this like an annuity. Now, I know annuities have a bad reputation, and I'm not saying this is an annuity, but the math works like an annuity, where in an annuity, you take a dollar amount and you invest it, and you get guaranteed payments over your lifetime. Well, they're not going to pay you very much in guaranteed payments because they don't know how long you're going to live. And so they've taken that annuity amount, they figured out, hey, if we took this $100,000 and it earns a certain amount of return over time, how much can we give this person based on their current age per month? And it's a complex calculation, but that's the same similar calculation we're doing on monthly payments. I'll be honest, very, very few of my clients choose the monthly payment option. Most of the time, they simply do the lump sum for what they owe on the mortgage or what they need right now, and then they leave the rest of it as the line of credits. So that's the last of the three pieces of the pie, is the line of credit. And I want to explain how the line of credit works. And the cool thing is the line of credit actually will grow. Okay. And I'll explain the line of credit growth in a few minutes. The line of credit is very similar to your home equity loan, or excuse me, your home equity line of credit, very much like your credit cards. You had a cap of how much you could borrow that was determined on day one. Anything you didn't borrow in the lump sum or didn't use to set aside for the LESA or to set aside for the monthly payments is available as a line of credit. You can call it any time that you want. You call up to the servicing company, you say, hey, I need some more money. Can you send me $5,000? Can you send me $1,000? Can you send me $50,000? And you can use that money for anything you want. You want to take the kids and grandkids on a world cruise? Go for it. You want to put a new roof on your house? Go for it. You want to go to Tahoe and bet it on black? Not a good idea. Don't gamble the money away. I'm serious. The other thing I want to be careful about is there's a lot of bad press, there's a lot of bad people who have encouraged people to go out and get reverse mortgages in order to take money out of their home to invest in the stock market. That is a really, really bad idea. Okay. You're taking a risk on your home anyway, and you're putting that money into another risky investment. That is not a good idea. So don't let somebody talk you into that. There's laws against that, prohibitions to that. Do not get caught up in that position. What you're looking at is the line of credit, though, can be used for anything that you want. It is entirely your choice. Okay. So let's now talk about how much money can you access. And that's critical to understand. There's a formula that takes into account your age. Your age has to do with your life expectancy. And what we're worried about is the younger you are, the longer you're going to live, the less we can loan you of what your house is worth, because we need to leave more room for the interest to be added over the life of your life. Okay. The second thing we care about is the home value. So the home value, there's kind of two parts to it. It's a little bit tricky. So you have the value of the home, but these are all backed by FHA, and FHA's current limit is about $636,000 on reverse mortgages. That means if your house is worth more than that, you have to deal with that cap. Now, there's other types of loans. There's jumbo reverse mortgages, but there's tiers on each of those. I just did a reverse mortgage for somebody last month, and their house was worth $1.1 million. They thought it was worth $1 million. It ended up being worth 1.1, but it didn't increase the amount of money they had available on their reverse mortgage because they hit the cap. And when you hit that cap, no matter how much your house is worth above that cap, it didn't change how much you can borrow. So different rules under different circumstances. I'm not going to take the time in the next 20 minutes I have to explain it in that level of detail. I'm just going to explain your home value matters to a certain point. Once you get over a certain point, don't be surprised if you find out, hey, your house is worth more than you thought, but it doesn't give you access to your reverse mortgage. The third thing we care about is what's called the initial interest rate, or the expected interest rate. It's a better way to put it. The expected interest rate is a formula that says, hey, here's where you're at today. And if you're on an adjustable rate, which most of you will be, explain why in a minute, then you have an expected interest rate that says, hey, with averages of where we expect rates to go, this is the expected interest rate. The higher the expected interest rate, meaning the higher the rate is when you start out, the less we can loan to you because we have to leave more room for that interest to be added. So it's the same as your age. The younger you are, the more time we have to leave for your life expectancy, and we have to leave then more room for the loan to grow. The higher the interest rate, the more we need to leave room for the loan to grow. But here's the general idea. You can generally expect to borrow about 50% of the value of your home. So if your home is worth $500,000 and you're in your early to mid 60s, it's a fair guess, totally a guess. It's a fair guess that you can access about $250,000. So if your home's worth 500 and you owe 400, it's likely you don't have enough equity to qualify for a reverse mortgage. Now, if you're 90 years old, now we can loan you a bigger percentage of what the house is worth. Not sure we're still going to loan you 80% of the home value, but the numbers do go into play with age and home value and expected interest rates. But again, 50% is a fair starting point. Please do not self-diagnose and say, oh, forget it. I'm not going to call John about a reverse mortgage because I owe more than 50% of my home value. I'm just giving you a rough idea. If you put 10% down 6 months ago on a home, you're not going to qualify for a reverse mortgage. If you have a pretty decent amount of equity, you're going to qualify likely for a reverse mortgage. That's really my point in talking about this. Okay, so the next thing I want to talk about is, can I access all the funds in the line of credit right away? The answer is no. So the federal government, one of the other problems with reverse mortgages, the first major problem in the past was the fact that under 62, your spouse couldn't go on the loan, and they ended up losing the home because that spouse, the older spouse, passed away. That's no longer an issue. The second major issue that we had was people would spend all of their money right away. Now, you might say, John, that's my choice. I can do whatever I want. But a lot of people just didn't understand that they were going to have other expenses and other needs down the road, and they no longer had any equity in the home. So the federal government set up a rule that says you can only borrow 60% of your line of credit in the first year. And then at the end of the first year, you have access to the rest of the line of credit. So just be aware as we talk about numbers that there may be a limit to how much of your line of credit you can access. Now, I told you a moment, half of what your house is worth on average. So if you have a $500,000 valued home, you can access 250. If you owe nothing, then your line of credit that you can tap into immediately, your lump sum up front, is capped at about 60% of that 250. But if you owe $200,000 on your mortgage, you can you're choosing to tap into. But the money you have to take as a lump sum, you can take all the way up to 100% of your available funds. So I hope that makes sense. And I'm going to move on from here and let's go on to the next step, which is how does the line of credit grow? So remember, 3 ways you can use the money. If you take a lump sum, that money is tied up. If you take monthly payments, the money set aside for the monthly payments is tied up. But the line of credit is not tied up. And the older you get, the truth is, it sounds kind of morbid. It's a fact. When you think about life expectancy, every year you live is one less year of your life expectancy. And so there's less time we have to worry about that interest being added. And you didn't owe any interest on the line of credit portion that you have available because you haven't actually borrowed that money. So your line of credit gets bigger every year. That has nothing to do with your home value going up or down. A reverse mortgage can never be taken away from you, even if home values go down. If home values go up significantly, you don't get access to extra money because the value's gone up unless you refinance. I'll talk about that in a couple minutes. But the fact is that your line of credit will grow and get bigger. And so that's a benefit over time. Okay. So now let's look at, I understand I had some technological issues, but it looks like we're good now. All right. So should I get a fixed rate or a variable rate? That's something that is super critical to understand. And what I want to explain here, this is a chart that you're looking at. And this chart talks about the first column being a variable rate option, the second column being a fixed rate option. This is a quote that I put together for a client a couple of months ago. Actually, a couple of weeks ago, I should say. So hopefully I'm not freezing anymore. Thanks, Kathy, for telling me that. All right. So this is a quote I put together a couple of weeks ago for a client. I've eliminated the personal information so that you don't know who this belongs to. But the bottom line is what you're seeing here is the left column is the variable rate. And I'll explain to you what you're looking at in case it's too small. So what you're looking at is an initial interest rate of 4.5% if it's variable. If this client wanted a fixed rate, it would be 6%. So they have the option, they can get a fixed rate loan, but it's going to be an interest rate of 6% compared to 4.5%. The reason people are afraid of getting variable rates is simple. Variable rates have gotten a bad rap because you don't know how much your monthly payment is going to be. That's it. It's that simple. On a traditional forward mortgage, you have to make a monthly payment every single month. And if you have a variable interest rate, you don't know how much that interest rate is going to be. You cannot afford to not know how much your monthly payment's going to be. But on a reverse mortgage, you're not writing a check. So you don't have to worry about, can I budget for that interest every single month? Can I budget to have a payment that's going to fluctuate? And the benefit of a variable rate is 2 things. First and foremost, when rates go down, you don't have as much money added. So rates are going to go up, rates are going to go down. With a variable rate, my mom has a variable rate or adjustable rate, and her rate's been as low as 2% a while back. So rates can come way down. But here's the final piece. And I'm going to go back to that slide I was just showing you. And if you can pull up the slide we were looking at a second ago. So what I want you to see here, let's make that bigger. What I want you to see here is the available funds. Remember I said that you're only allowed to tap into 60% of your available funds? When you do a fixed rate loan, you do not have the option of a line of credit. You do not have the option of monthly payments. A fixed rate loan means you are taking your lump sum one time and that's it. So you have no flexibility to say, you know what, I'd like to access more money later. And as a matter of fact, you can only access the 60%. So what we're looking at here on this one, and let me kind of take a look here to see if I can see the numbers. So oops, I didn't mean to do that, gang. These numbers are a little bit small, but the bottom line is this client, their principal limit is $387,000 on the variable rate. Because the fixed rate's higher, it's $30,000 less. They can only access $357,000. But what you look at down here, it talks about line of credit available, and there is no additional line of credit. So that person can take, this client can take $203,000 today, and then they can access another $27,000 down the road. Actually, I took that. I can't even see on that one. I apologize, guys. But down here at the bottom, they have extra money. There's a computer glitch, but they have access to remaining funds. Actually, let me count these numbers. 150,000 approximately that they're going to have available after year one. So they get 203,000 now and another 150,000 after year one. If you take the lump sum, you cannot access that extra $150,000 after year one. You're limited to, in this case, $191,000. Now, maybe that's okay, but one of the biggest benefits of reverse mortgage is the flexibility to access money down the road, because once you've paid the fees to take out the mortgage, you're done. There's no extra fees to borrow money down the road. If you do the fixed rate option, you cannot tap into more money down the road. That creates a very significant challenge when you're trying to figure out, hey, how do I use this as a benefit to me down the road? The fixed rate handicaps you. It handcuffs you and doesn't give you the kind of flexibility that you would have had otherwise. All right, so let's keep going here. I got about 10 minutes left. I've got a couple of questions in the chat. If you have more questions, you're watching live, post them. I'll cover them before we end. If you're watching recorded, post your questions anyway, and I'll come back. I'll be notified, and I'll answer those questions. Does property condition matter? Yes. The property has to meet FHA's property condition guidelines. So if there's challenges with the property, those challenges have to be fixed before we can give you the reverse mortgage. That's one of the things you need to be aware of, is the property has to be in good condition. So that's super, super important. All right, so let's talk about, what do I owe when the house is sold? This is a chart that gives you an idea, and if you can make that bigger for me, perfect. This is a chart that basically, for this client, they borrowed $232,000. So you see on year zero, they owed $232,000. Their house is worth $945,000, and they have $712,000 in remaining equity. Well, if you go down to year number 10, they have a balance of $415,000. So their loan amount has gone up by over $200,000. But using normal rate of increase of appreciation, which it is typical that houses appreciate 3 to 4% per year, that means on average, their house is going to be worth $1.4 million in 10 years. That means that instead of only having $712,000 of available equity that goes to your family, they're actually going to have $982,000. So remember, your reverse mortgage balance will go up, and you're only going to pay off what you borrowed plus whatever interest was added over the life of the loan. It's no different than a regular mortgage where you pay off what you borrowed minus whatever interest and principal, well, interest you went to the bank, minus whatever principal you've paid back. But in this case, the balance is growing. You only owe what we've added in interest. There used to be reverse mortgages a long time ago where you actually had to split the equity with the bank, and those are no longer true. So that's a myth that you may have heard in the past that just is not the truth, and you do not have to worry about that. All right, I've got a couple of really good questions here, so I'm going to make sure we get some time to cover those questions. Let's get back and talk about, what if my spouse is less than 62 years old? I already covered this in general, but very simply, if your spouse is less than 62 years old, you can still get the reverse mortgage. But if you pass away or cannot live in the house, the older spouse, before the younger spouse is over 62, the younger spouse kind of reverts to what the fixed rate looks like, not because it's a fixed rate, but they no longer have access to monthly payments. They no longer have access to the line of credit, but they don't have to move out and they don't have to make monthly payments. I can explain that in a little bit more detail one-on-one if that's your situation, but I wanted to cover that in general. Here's a couple of big things I want to cover before we finish. When does the reverse mortgage end? It ends when the last borrower, so out of everybody who was a borrower on the loan, either passes away or cannot live in the home for a year. That's it. So this reverse mortgage, you'll never need to make payments. You can continue getting your monthly payments or access to the line of credit until the last borrower passes away or cannot live in the home for a year. At that moment, the mortgage becomes due. Your family has the option of what they want to do with it. And I'll explain those options in a second, but they're given 6 months to do that. So your family is given 6 months to sell the home. If they can't sell the home, if that's their choice to sell it, if they can't sell the home in 6 months, then the bank has the option to grant you 2 additional 3-month extensions. So you can have up to a year to sell the property after you pass away. Or you can't sell it. Your heirs have up to a year to sell the property after you pass away or cannot live there for a year. The confusing thing is the whole cannot live there for a year. We don't wait until the end of the year. When the reverse mortgage is notified that you are no longer living in the home, even if you have not passed away, they're going to ask the doctor, hey, is this a short-term or a long-term thing? They're going to want to get confirmation of, are you out of the house because of a temporary need, or are you out of the house because of a permanent situation? And if you're out of the house because of a permanent situation, that moment the mortgage becomes due and the 6-month clock starts ticking. Now, what can the family do in that 6 months? Well, there's 2 circumstances. Either you have equity, meaning that you owe less than what the house is worth at the time. And if you have equity, you can refinance it to a forward mortgage. I do that all the time for my clients where the family, the person who took out the reverse mortgage is gone. And they say, I want to keep the house. I want to keep it as a rental, or I want to move into it as a primary. And we just do a refinance to pay off whatever the balance of the reverse mortgage is into a forward mortgage. You could technically refinance it into a new reverse mortgage if the family member that is taking over is moving into the property as their primary home and is over 62 years old and there's enough equity. They have to qualify all over again, okay? Your family also has a choice, if you have equity, to sell the property, and they keep the equity, they keep the extra amount. And so that's just like a regular sale. If you took out a traditional mortgage and you passed away, your family has to sell the property. They have to pay off the mortgage company, and then they get the rest after paying the fees for selling the property. It works the same for a reverse mortgage. It's just the balance kept going up every year, like the chart that I showed you a couple of minutes ago. But here's where it gets tricky. Where it gets tricky is if you owe more than what the house is worth. So if you're in that situation where you owe more than what the house is worth, then your family's options change. And at that point, their option is to give the house back to the bank. That may be the best option. Hey, there's no sentimental value to the home. I'll tell you a quick funny story. My father's life goal was to get my father hated banks, absolutely hated the banking industry. His life goal was to get a reverse mortgage and then outlive the reverse mortgage so that it was upside down. Because in his opinion, he didn't have to make those payments. Every dollar the principal went up was interest he got to keep in his pocket and not make a monthly payment. And in the end, he screwed the banking industry. Literally my dad's thoughts. Unfortunately, he didn't live long enough to make that happen, but he's probably hoping right now that my mother does and that she screws the banking industry. But the bottom line is that you give the home back to the bank. It's no big deal. You're done. You just call them and say, hey, mom and dad are passed away and the house is upside down. So it goes into foreclosure, which is really what Penny said. So there was a comment that Penny brought up that I'm going to bring up here. And she says, the reverse mortgages that I've dealt with in the past end with foreclosure. That's a good outcome if the property is upside down. Now, you can technically do a short sale. You could sell the house and have a realtor sell the house and do a short sale. But the fact is there's no equity for the family to have. And so in that case, as my father said, well, we screwed the bank because we ended up getting more money out of it than what we would have if we had not taken out the reverse mortgage and sold the house traditionally. So a foreclosure is not a negative outcome. Remember, the person who borrowed the money is gone. It's not going to hurt their credit. And they got the benefit of basically getting money out of the house more than what the house was worth in the end. So that actually isn't a bad outcome, Penny, but a lot of people want to keep the house. And that's where the second option comes in, which is the bank has now said, look, if I sell the house, I'm going to give you simple numbers, gang. If you owe on a reverse mortgage $600,000 and the house is worth $500,000, the bank, you can let it go. The bank's going to sell it for $500,000 and they're going to have to pay fees to real estate agents to sell it. And so they're not even going to get $500,000. They're probably going to have at least 5% of the value of the home as fees for selling the home. So really the bank's only going to get $475,000. So the banking industry has decided, why do we want to prohibit the family from having that same deal? So your family, your heirs, can buy the house from the reverse mortgage, not buy it from them, basically refinance it and only have to pay back 95% of the appraised value. Instead of paying back the $600,000 that you owe, they only have to pay back 95% of the $500,000 it's worth, or $475,000, and they can keep the home. So that's a super important option that allows you to keep the home. All right, let's make sure I'm just about out of time. I've covered all of the questions. I want to make sure I cover the process. By the way, you absolutely need a living trust. It is super imperative if you're thinking about doing a reverse mortgage that you get a living trust. I can explain to you more about it. Next month, I'll have an attorney on talking about living trusts and why that matters, but I'm out of time. So let me explain to you what the process is to get a reverse mortgage. You need to meet with me for my initial conversation. We're going to talk about why you shouldn't and why you should. If you still think that you should, then we're going to do a second meeting that we're going to review your specific proposal. I'm going to put together the charts that show the interest rate options, the available funds, how much the balance is going to grow over time. If you like the actual numbers, you have to get counseling. It's required to do counseling to make sure you understand from a neutral third party all the pros and cons, and that you're not being forced to do this by me or by somebody in your family. Once you've gone through counseling, then I can start the actual loan. I pull your credit. I get you to give me documentation of your income. We get the appraisal done, and then we do underwriting. And then once underwriting's approved the loan, you sign and you close, and your traditional mortgage is paid off, and you never make a mortgage payment again. Just recognize this can be a 2 to 3 month process from start to finish. So if you're in a hurry, recognize this isn't going to go very fast. All right, couple of last things I want to cover. Why are they so expensive? It's the mortgage insurance. I talked about that earlier, so I don't need to do that at all. Two last things I want to cover is, why would someone with a reverse mortgage want to refinance it to another reverse mortgage? There is only one reason, and that's if you have no more money left in your line of credit and you want to access more funds. My mom gets calls every single month from loan sharks asking her to refinance her reverse mortgage. And every once in a while she calls me and says, John, should I do that? First of all, Mom, if you do it, please do it with me. Secondly is, no. Do you need access to more money? No. Have you pulled more money out of your reverse mortgage? No. Then there is no reason for you to pay more in fees. They're going to try and convince you of that, but it just isn't true. You're going to waste a lot of money in fees. Do not do that. The last point I want to make is, you can now use a reverse mortgage to purchase a home. You can, as long as you have a big enough down payment, you can take out the reverse mortgage as the purchase loan. The challenge is these loans take a little bit longer, so you have to be able to have an extended escrow. So talk to me about that before you start writing offers using a reverse mortgage, but it does benefit you because then you do not have to pay fees twice. My mom paid fees twice. She did the traditional mortgage and then turned around and did the reverse mortgage. All right, I apologize for being 2 minutes over. That was a lot of information. Thank you so much for your time, guys. If you have any questions, I'll be here for another quick minute. Feel free to post them into comments. Please like and share. Join me next week. So next week, I'm going to talk about refinancing. And is it a good idea to refinance your home? Most people think the only reason to refinance a home is if I can get a lower interest rate. Interest rate is one component, and it's probably the least important component. Now, there's reasons why you shouldn't, but interest rate is not the only reason, and it's not the most important reason. So join me next week. Please share this with anybody that you know. And if you have questions about reverse mortgage, I would be honored to have the opportunity to help you to look at whether it's the right solution for you or not. Doesn't look like anybody has any other questions. Thank you again for your time today. Enjoy the rest of your Friday the 13th. And if you're watching this recorded, please give me a comment and let me know what you liked about this and what questions you have. And I'll talk to you all soon. Have an amazing weekend. Bye-bye.